Good afternoon, everybody. Welcome. And in particular, allow me to welcome the 4 young ladies in the front. They are the winners of the MPC School Challenge, and they've come to listen to the press conference and meet with us afterwards. So congratulations to all of you. It is from Springs Girls High School, and your teachers with you. Welcome. And we're delighted that you've participated, and congratulations on your winning. It's a very good competition. I think we can just give them a round of applause, and thanks to all the MPC members. Can you hear me okay? Is it coming through okay? Clearly? Okay. Since the previous meeting of the Monetary Policy Committee, domestic inflation has breached the upper end of the target range. This development was in line with our forecast, and we continue to expect inflation to moderate somewhat in the final quarter of this year. While the outlook for the domestic economic growth environment remains unchanged, it has been overshadowed by protracted work stoppages. Where wage agreements have been reached, these have generally been above their headline inflation rate, contributing to the upside risk to the inflation outlook. During this period, global financial markets have been dominated by continued speculation about the speed and timing of tapering of quantitative easing by the US Fed. The uncertainty related to this event resulted in a high degree of volatility and weakening in a number of emerging market economies, foreign exchange and bond markets since May. The decision by the Fed to delay tapering surprised the markets, and emerging market currencies in particular responded strongly, with many seeing significant overnight currency appreciation. The Fed emphasized the data-dependent nature of its decision, indicating that this respite could prove to be temporary, as speculation regarding the timing of future tapering is likely to continue whenever positive data emerges from the US. The year-on-year inflation rate as measured by the Consumer Price Index for all urban areas increased to 6.3% in July and 6.4% in August. Food and non-alcoholic beverages inflation measured 7.1% in August, up from a 6.8% in July, while petrol prices increased at a year-on-year rate of 23%. Core inflation, which excludes food, petrol and electricity, measured 5.1%, down from 5.2% in July, while administered prices excluding petrol moderated to 7%. The headline producer price inflation for final manufactured goods accelerated to 6.6% in July, up from 5.9% in June. The inflation forecast of the bank has deteriorated further since the previous meeting of the MPC. The forecast for 2013 is unchanged at an average of 5.9%, but inflation is now expected to average 5.8% in 2014, compared with 5.5% in the previous forecast. The forecast for 2015 has been raised from 5.2% to 5.4%, and inflation is expected to average 5.3% in the final 2 quarters of that year. The current breach of the inflation target is still expected to be temporary, and the peak was possibly reached in August. The deterioration in the forecast is mainly due to changes in assumptions related to the exchange rate of the rand and petrol prices, but given the overnight developments, these assumptions will be revisited on an ongoing basis. The forecast for core inflation for 2013 is 0.1 percentage point lower, at an average of 5.2%. This measure is then expected to average 5.4% and 5.3% in the coming 2 years, compared with the previous forecast of 5.2% and 5% respectively, and to measure 5.1% in the final quarter of 2015. This upward drift of underlying inflation is due to the lagged effects of the depreciation of the rand exchange rate and the impact of higher unit labor costs. Inflation expectations, as measured in the survey conducted in the 3rd quarter of 2013 by the Bureau for Economic Research, have remained stable around the upper end of the target range. It is of concern to the MPC that inflation is expected to average 6% in 2013 and 6.2% and 6.1% in the subsequent 2 years respectively. Business respondents expect inflation to average 6.4% in both 2014 and 15, slightly lower than in the previous forecast, while expectations of trade unionists are unchanged from the previous survey at 6.2% and 6.3% for these respective years. The expectations of economic analysts have deteriorated slightly since the previous survey, but still expect inflation to average below 6% over the period, and to average 5.8% and 5.5% in 2014 and 15 respectively. Global economic prospects have improved in a number of the advanced economies, but downside risks remain. Growth in the US appears to be gradually improving, despite fiscal headwinds, and most forecasts are for growth in excess of 2.5% in 2014. There are, however, a number of downside risks to the outlook, which were also highlighted by the Fed. Financial conditions have tightened since the initial tapering announcement, and there are fears that the significantly higher mortgage rates and the observed downturn in mortgage applications could derail the nascent recovery in the housing market, posing a risk to household consumption expenditure. Fiscal policy is also seen as a source of downside risk, with a debt ceiling issue expected to resurface in mid-October. Failure to find resolution could result in further unplanned fiscal expenditure cuts. The Eurozone emerged from its protracted recession in the second quarter of 2013, led by Germany, but economic growth is expected to remain weak and below trend for some time. This negative outlook is compounded by fragile political environments in a number of countries, including uncertainty regarding the ability of some of the peripheral countries to meet the conditions of their bailout clauses amid stringent fiscal consolidation measures and deteriorating debt dynamics, and slow progress towards a banking union. The Japanese economy appears to be responding to the stimulus packages and the weaker yen, but it is still too early to assess the sustainability of their recovery. Fears of a marked slowdown in China have abated somewhat following strong growth in industrial production in August, amidst easing liquidity and bank lending conditions. While there are some concerns that the recent improvement is based on an unsustainable credit boom, growth in excess of 7% in 2014 is generally expected. The expectation of an end to US quantitative easing prompted a sell-off of emerging market assets, which has the risk of further undermining the weaker growth outlook that has been apparent for some time. While financial markets in these countries have reacted positively to the Fed's decision not to begin tapering at this stage, the underlying weaknesses are expected to persist. Monetary policy in the advanced economies remain highly accommodative, and forward guidance suggests that low policy rates will be maintained for some time. Inflation in the advanced economies remains very low, but there is speculation that a faster than expected decline in the US unemployment rate could prompt an earlier start to normalization of monetary policy in the US. Some emerging markets, notably Brazil, Indonesia, Turkey and India, have either tightened monetary policy in response to currency depreciation, implemented a range of direct controls on capital flows, or engaged in direct intervention in the foreign exchange markets. The exchange rate of the rand has been highly volatile since the previous meeting of the MPC, against the backdrop of a widening current account deficit, domestic labour disputes, and the reversal of capital flows to emerging market economies. The rand's strong co-movement with other emerging market currencies suggests that external factors predominated over this period. Since the previous MPC meeting, the rand has fluctuated in a range between around 9 Rand 55 and 10 Rand 50 against the US dollar, and appreciated by 2.3% against the dollar, but is more or less unchanged on a trade-weighted basis. The uncertainties related to possible changes in US monetary policy have reflected in the volatile non-resident activities in the domestic bond and equity markets. Following net sales of domestic bonds to the value of $17.9 billion between May and August in reaction to the Fed tapering announcement, non-residents have been net purchasers of bonds in September to the value of $9.3 billion, bringing the cumulative total since the beginning of the year to $14.9 billion. Non-resident appetite for domestic equities has remained strong following net sales in 2011 and 2012, with year-to-date net purchases of 28.3 billion rand. The risks to the inflation outlook from the exchange rate remain elevated and dependent on its future trend. A sustained depreciation trend could pose a significant risk to the inflation outcome. While there are some signs of generalized price pressures evident in the producer price index, to date the pass-through to consumer price inflation has been relatively muted, given the weak pricing power in the current low-growth environment. The rand is expected to remain sensitive to global sentiment as well as to the current account deficit, which widened to 6.5% of GDP in the second quarter of 2013. The deficit is expected to narrow in the coming months in response to the depreciated currency. However, this response is expected to be slow given the import-intensive nature of capital expenditure by the state-owned enterprises in particular. Furthermore, export revenues are hampered by weak external demand, strike activity in the mining and motor vehicle sectors in particular, and declining terms of trade. The stepping up of exports is critical to address the current account deficit. While the rand has appreciated significantly in the last few days, the experience of the past few months is indicative of its vulnerability to future changes in U.S. monetary policy. The domestic growth outlook is unchanged since the previous MPC meeting. The real GDP growth rate of 3% recorded in the second quarter of 2013 was driven mainly by a recovery in the manufacturing sector following the marked contraction in the first quarter. Despite the rebound, growth was below the estimated potential of around 3.5%, and the negative output gap widened further. The bank's forecast of GDP growth is unchanged. We still expect growth to average 2% in 2013 and 3.3% and 3.6% in the next 2 years respectively. The composite leading business cycle indicator of the bank declined slightly in June, continuing its broadly sideways movement, confirming the subdued growth outlook. Business sentiment remains weak. The RMB-BR Business Confidence Index declined from 48 index points in the second quarter to 42 index points in the third quarter. There are, however, tentative signs of improvement in the manufacturing sector. The Kagiso PMI index increased to its highest level in 6 years, and in July the physical volume of manufacturing production increased by 3.5% on a month-on-month basis and 5.4% year-on-year. Capacity utilization also increased marginally in the second quarter of 2013 to 81.3%. Despite these positive trends, manufacturing output is expected to be adversely affected by protracted strikes, particularly in the motor vehicle sector. Mining output, which contracted in the second quarter, is expected to contribute positively to growth in the third quarter, following strong increases in production in July and a relatively quick resolution of the strikes in the gold mining sector. Growth in real gross fixed capital formation remains relatively weak, at an annualized rate of 2.7% in the second quarter of 2013. A positive feature is the acceleration in the growth of private sector fixed investment expenditure to 4.4%, which more than offset the decline in outlays by the public corporations, mainly due to unplanned construction delays. Gross fixed capital formation as a percentage of GDP increased marginally to 19.5% in the second quarter, still well below the levels of around 24% reached in 2008 and the National Development Plan target of 30% by 2030. Employment trends remain extremely subdued, consistent with the slow pace of economic growth. According to the quarterly employment statistics of Stats South Africa, formal non-agricultural employment increased by a mere 7,000 employees, or 0.1%, between the quarters ended June 2012 and June 2013. Of great concern is the loss of jobs in the tradable sectors of the economy. Over this period, there was a loss of 23,000 employees in the mining sector and a total of 7,000 in the manufacturing and construction sectors, while there was an increase of 26,000 employees in the community, social and personal services industry. Growth in final consumption expenditure by households has been on a declining trend since the first quarter of 2012, but may have bottomed out, having increased from 2.3% in the first quarter to 2.5% in the second quarter. There was a notable increase in the consumption of durable goods, which could include preemptive buying ahead of possible exchange rate-induced price increases, as reflected in the sharp decline in new vehicle sales in August. The moderate trend in consumer demand is also reflected in the 2.8% year-to-year increase in retail trade sales in July, and the month-on-month decline of 0.5%. The FNB Consumer Confidence Index increased significantly in the third quarter, and expenditure is expected to be positively affected by higher wage settlements and positive wealth effects. Nevertheless, consumption expenditure growth is expected to be constrained by low employment creation, high household debt levels, declining rates of credit extension to households, and high petrol and electricity price increases, all of which are likely to curtail discretionary spending. The trend of wage settlements remains an upside risk to inflation and job creation. The current wage bargaining round has seen a wide range of settlements, generally above the current inflation rate. According to Andrew Levy Employment Publications, the overall average wage settlement rate in collective bargaining agreements was 7.9% in the first half of 2013, and this is likely to have increased in the third quarter. According to data derived from the QES, average salary and wages per worker over 4 quarters increased by 8.7% in the quarter ending June 2013. But when accounting for productivity increases, the unit labor cost increase amounted to 6.8%. The ultimate impact on inflation will depend in part on the increase in the total wage bill, as the impact of higher wages may be offset by job losses or slower employment creation. We are concerned that the increase in productivity, although relatively low, reflects job losses and a switch to more capital-intensive production. The moderate pace of bank credit extension to the private sector has been maintained, with 12-month growth of 8.7% in total loans and advances recorded in July. Installment sale credit and leasing finance remained robust, while growth in general loans to households, which is mainly unsecured lending, declined to 20.2% in July, the lowest rate of growth since August 2010. The shorter-term trends for unsecured lending are more marked, with growth in the 3 months to July measuring 11% and negative growth in loans of less than 30,000 rand. Growth in mortgage credit extension has remained subdued. 12-month growth in credit extension to the corporate sector declined from 10.5% in June to 8.7% in July, with some indications that this reflects a lack of demand by corporates. They remain relatively cash flush and have also placed increasing reliance on corporate bond issues. Food prices are a risk to the inflation outlook, although the continued downward trend of international food prices has helped to offset the impact of the weaker rand on maize and wheat prices. Consumer food inflation measured 7.4% in August, while at the producer price level, manufactured food price inflation measured 7.5% in July. Price increases of agricultural products, by contrast, were muted at 0.5% in July, with year-on-year declines in the prices of cereals and meat, but strong increases of 21.4% in fruit and vegetable prices. The immediate risks to inflation from international crude oil prices appear to have abated for now, following a decline in the political risk premium, but prices remain highly sensitive to developments in the Middle East in particular. Having increased to a level of around $118 per barrel in response to events in Egypt and Syria, the price has since moderated to around $110 as the risk of U.S. military action in Syria has subsided. Petrol prices increased at a year-on-year rate of 23% in August, but favorable base effects and the small decline in the price in September are likely to result in a far lower rate of petrol price inflation in that month. The combination of a lower oil price and a stronger exchange rate observed in recent days is likely to result in a further moderate price decline in October, reversing the expectation early in the month of a further significant increase. The Monetary Policy Committee assesses the risks to the inflation outlook to be on the upside, mainly due to exchange rate and wage pressures. The decision of the Fed to delay tapering has provided a temporary reprieve to the exchange rate. However, the continued uncertainty relating to the timing of the inevitable slowdown in bond purchases and its data-dependent nature imply that emerging market currencies, including the rand, are likely to experience a protracted period of volatility. In the short run, these developments may have moderated the risk to inflation from the exchange rate, but medium to longer term risks remain, which will be assessed on an ongoing basis. The MPC remains mindful of the conflicting policy choices that it faces. The breach of the upper end of the inflation target is expected to be temporary, but the longer term trajectory is uncomfortably close to the upper end of the target range. At the same time, there are still no significant demand-side pressures in the economy, and consumption expenditure growth is subdued. The output gap continues to widen, and the employment data show that there is very little net employment creation in the economy, while employment in the manufacturing and mining sectors has been declining. Consumers remain under pressure with persistently high debt-to-disposable income ratios, further exacerbated by the rising cost of petrol and other administered prices. Currently, a sustained breach of the inflation target is not our central forecast, but the upside risks to the inflation outlook require fairly careful monitoring. Should the risks to the medium-term inflation outlook deteriorate significantly, the MPC will not hesitate to take appropriate action in order to maintain the integrity of the inflation targeting framework and to anchor inflation expectations at a lower level. At this stage, however, given the global uncertainties and downside growth risks, the MPC has decided to keep the repo rate unchanged at 5% per annum. Thank you, and I'm happy to take any questions that you may have, and so will my colleagues.
From The Economist magazine. You mentioned in your statement, Governor, three things. One, that wage settlements were running at around about 8%, which is a level not consistent with the inflation target unless you've got a very bullish view of long-term productivity in South Africa. That inflation expectations of both wage bargainers and trade unions are above 6%, and that wage growth adjusted for productivity unit wage cost is running at close to 7%. Now, one interpretation of that is that wage setters and trade unions no longer believe that the Reserve Bank is capable of keeping inflation within the target range over the medium term, and that more than careful monitoring might be needed. What's your response to that?
Well, I think that there are a number of issues as to what is driving the question of wage increases. And if you look at it, the demand of wages and the actual settlement are vastly different. So that you can have wage demands at the start that are very different from what the ultimate settlement is. But as we said in the statement, we are concerned that it remains above the inflation target band, even if relatively reasonably compared to where the wage demands start. Is this a reflection that they don't believe that CPI will be contained within the band? I think that's less to do with the issues than with the dynamics of labour in South Africa at the moment. And I think that it is the responsibility of employers and employees to find ways in which you come to some understanding of what is doable. The risks to jobs are great, and that's what we're also emphasizing, is that it may not affect the total wage bill. So that in terms of inflation, the pass-through and what would affect it would depend on what is the total wage bill. And what we're seeing is that one of the impacts is job losses. That is clear in the numbers that have just come out. So I think they should not doubt that the bank will do what is required. But as we've said in the statement, it's a balancing act at this point in time as to what is appropriate, because we have different policy responses to the challenges that are facing us. Slower growth, rising inflation. And at this point in time, we feel that it is the risk to inflation, and we've emphasized that in the statement, is something that, in fact, in our view, is increased. So we are advising to the best that we can about our concerns of rising inflation, and that it is at the upper end of the band, and in terms of expectations, but also that the last two numbers have, and as we said, we expected the third quarter to breach the band and average 6.3%. But that is certainly of concern for us, and we are emphasizing our concerns there.
Governor, good afternoon. It's Renee Volgraaf from Bloomberg. I'm sorry if I missed it in the statement, but I just want to check at the moment, what is the MPC's forecast in terms of when inflation will be back within the target band?
Brian, do you want to just deal with that in some detail?
Yes, the forecast for 2013 is more or less unchanged relative to the previous forecast. So, as expected, we have reached the upper end of the inflation target for this quarter. We expect that the August number was probably the peak, and that it'll start moderating from then. So we expect in the fourth quarter that we'll be back at the upper end of the target range, but not necessarily for every month in that quarter, but on average we should be back in that quarter. So it is more or less the same as the previous forecast, that the peak is in the third quarter and we're back in the fourth quarter.
Sorry, I just want to check back within the range, not just back at the upper end.
We'll be back in the range at the upper end.
Thank you.
Yes.
Good afternoon, Governor, members of the MPC and the press. If the economy is to recover and the rand is to stabilize and the foreign economy is to improve, impacting positively on our exports and our South African economy, what decision would be taken in terms of the repo rate?
Who would like to deal with that one? Rashad?
Well,
There are lots of ifs there.
yeah. Look, I mean, the question is that there's too many imponderables. It's very difficult to say a decision would be made. I think the critical thing is to look at the logic of how the MPC operates and what the inflation targeting framework is all about. If the economy picks up and there's economic growth is very robust, but there's a real threat to demand side inflation, then you can imagine, in that scenario that the MPC would react very differently if the economy picks up but inflation is rather benign. So this important variables of kind of whether inflation is above or below the target, the trajectory of inflation related to what happens with growth is what ultimately determines are key parameters for determining the way we think about monetary policy.
Yes, sir.
Pat McGrody from the Wall Street Journal. You mentioned in this statement that the Federal Reserve's decision last night has brought some reprieve to the rand, but that the outlook is uncertain and continuously volatile. Could you just elaborate on how expectations for eventual Fed tapering are going to impact on the rand and South Africa's economy, and whether concerns that you and the finance minister have raised about the increasing connections that South Africa has to those decisions, whether those have been addressed?
Well, look, I think that's a very multi-layered question. First of all, in terms of its potential impact, it depends how many times we're going to have meetings where there's an expectation. If you take like this meeting that has just been, an expectation that tapering will start and it doesn't. Because then every time there's good news out of the data coming from the US, and Bernanke made it very clear it's data dependent, there's going to be more speculation about whether there's going to be tapering or not. And as you've seen, is that then it builds its own momentum. And depending on whether that expectation is met, so that what our concern is that emerging markets, as you've seen, there's a band of emerging markets, including ourselves, that tend to sort of be tracked in a similar way at the moment. Malaysia, Turkey, Korea, ourselves, Brazil, and so on. So and Mexico, Poland. So part of the question is, how many times can we be hit by this volatility that will occur? So we're expecting that until there is a clear decision about it, which is the amount and how often and in what time frame, and that again depends on what happens with the US economy. So what the impact is difficult to quantify. I would hope that everybody just holds a very steady hand to the tiller and say, look, this is going to happen over time. It's going to be managed well. It's going to be something that does impact, but there's going to be clear notice about how it's working. And the Fed is trying to give that notification. But clearly it's a committee of a number of people, and it's quite difficult to predict with all of them. But the reality is it's a volatile time. And even when tapering starts, and I think that's very important to stress, is that when tapering starts, it's not yet raising rates. It's simply the reduction of the quantum of purchase per month. So that when you're looking at $85 billion and that begins to reduce, you haven't yet begun to raise rates, and they've made that very clear. That is a good few years away. So I think what it also indicates is the extent to which this global crisis is with us. So you may be out of recession, but you're not necessarily out of financial crisis, and it changes. The current mutation is the impact on emerging markets. So there is a complex environment in which the central banks are operating, and a lot of what the central banks need to be able to take account of is what happens in the other parts of the economy. a lot of the issues cannot be addressed in any country simply by the central banks. If you looked at what Bernanke had to say, it was about the concerns around the debt ceiling. And are we now going to have a close down of government, or the whole debate about it again? So that there's a lot of other issues that impact on the decisions. So the challenge for all of us is, in fact, if the US economy is recovering and growing, it's good news. In that good news, there are negative impacts while it adjusts, and we've all got to recognize how difficult that environment is, and that requires the coordination, certainly at the domestic level, of your economic policies, of your outlook about what you need to do to ensure that your country you try to minimize the impact on your country. But an impact there will be. Frans.
Governor Frans Wild from Bloomberg. Just to kind of follow up on that, is there any communication between the SARB or the Treasury and the Fed or other countries that you know of to discuss that? And do you have any idea whether the effect on emerging markets in general is something that the Fed would take into consideration?
They've made it publicly clear that they're very concerned and take account of it to the best that they can, given that they also have to do what is appropriate in their own circumstances. And yes, I can't, obviously there are a number of forums in which discussions take place. It's certainly not for me to discuss the content within, because these are sort of closed meetings. But there are regular meetings between governors and ministers at the G20 level, the Financial Stability Board meetings that look at some of the issues there, the BIS meetings, which are every 2 months, sometimes a little more, and where you have the opportunity to discuss with colleagues around the world, and to get a very good interaction. So yes, these matters are discussed and taken very seriously, whether by the Fed or any of the other countries, that the ECB, UK, advanced economies, emerging markets, sit around the table and try to get an understanding of what we're all seeing. Yes, sir.
Good afternoon, Governor. Tsepo Moe from SABC. In anticipation of the tapering, we've seen several central banks in emerging economies putting up measures to protect their currencies. And I know, certainly for South Africa, you believe in free floating currencies. Are there any short-term measures, perhaps, that you would consider?
Well, the question we've got to ask is what works. Part of it is if we looked at all the measures taken, and there's been a range, and it's not just now with tapering, it was before when you had an appreciating currency. With an appreciating currency, it was talk of currency war, needs to take measures against the appreciation, what kind of initiatives are possible. Our own view is that you can spend a lot of money and you can make a lot of interventions, but in the end, do they actually address the outcome? And in our view, the outcome is pretty much where we are without all of that. So each country is taking a decision in relation to its specific concerns and its circumstances. So if you take Brazil, for instance, if you talk about whether it wants to intervene in the currency, Brazil has close to $400 billion in reserves. South Africa has 45 billion. The choices Brazil has about intervention in relation to its reserves is very different from the choices we've got. So, they're able to do that, and if they spend, as they said they're going to use, I think it's $60 billion at the moment, is their purchase or what they're going to intervene with in the next year, in the current period. $60 billion is more than our entire reserves. So the choices depend on your own circumstances and what works. Obviously, there's a range, and I indicated a little bit in the statement. There's been various interventions that have been taken, and I hope for the countries that take them it works, but we've taken the positions we have, which is that a floating exchange rate is the shock absorber in these kind of circumstances, and that as a country we need to look at what we need to do together in all aspects of the economy, together, to ensure that we address the vulnerabilities that we have, because we are a country with a twin deficit, current account deficit, fiscal deficit, and that's why we've said again in the statement addressing the question of our exports becomes extremely important to address some of the pressures on the current account. So, those are measures that are not necessarily something the Reserve Bank can do, but as a country we can certainly take measure. I don't know if anyone would like to elaborate on anything. Dan? Yeah?
Yeah, maybe just to add, I think the Governor's covered that very comprehensively. I mean, the only issue that maybe one could add is that clearly if we got into a situation where there was a threat to our financial markets, to their orderly functioning, to the price discovery mechanism being jeopardized, extreme shortages of liquidity, and those kind of situations which clearly would amount to almost a crisis, we certainly would consider ensuring that our markets continue to function.
But that's the normal function of a central bank. That's what it does. Right? But in terms of what we've done up to now, we have not had a liquidity crunch at this point, and I hope we don't get one. So again, some of the challenges that the advanced economies have, that they need to resolve, have spin-offs for us, but they still need to resolve that. We can't be over-optimistic. As much as we want to ensure that things begin to work well, we've got to recognize that the recovery in Europe is very, very fragile. And they've acknowledged that very clearly. And Japan, we hope it succeeds. Very interesting what they're doing. China growth over 7%, a challenge, but emerging markets generally being impacted by what is happening in terms of the advanced economies. They were impacted before on the appreciation, now impacted again on the depreciation. So challenges for all of us. Let me see if there's anyone who hasn't asked. If not, okay, Renee and then Frans.
Governor, you mentioned the fact that the pass-through of the weaker exchange rate to inflation has been relatively muted up until now, but I would like to get an indication of how big the pass-through has been until now. And then also, to what extent is the MPC worried about the pass-through that might still come?
Would like to tackle that? Rashad?
Yeah, look, there are two issues. The one issue is what the forecast assumes the pass-through is based on a long-run trend. And in general, the forecast pass-through is about 20%, so or what we call elasticity of 0.2. So, a 10% reduction in say the exchange rate will lead to a 0.2% increase in the inflation rate. But what we've said is that one should look at is the evidence currently. So you've had this massive exchange rate depreciation going on for a while. But if you look at the inflation rate, it has been rather muted. In fact, a lot of the key drivers of the inflation rate are the usual suspects. It's been oil, it's been food to some extent, some of the administrative prices. However, we do say in the statement that we're beginning to see risk to inflation as a result of the exchange rate pass-through. But we're saying that because demand in the economy is low, you're not seeing the kind of robust pass-through you'd normally see in times of high demand in the economy. So that's exactly what we try to explain.
Frans? Sorry, Lesetja?
Yeah, just to add to what Rashad said, I think that the other important thing is the functioning of the local product markets. I think that if you looked at previous episodes of rand depreciation, you would have found that the pass-through was bigger and was more rapid. As you had witnessed domestic producers losing their pricing power, what that means is that they are unable to arbitrarily pass through price increases through the South African market. It's a very important aspect. So the price formation process in the domestic market is key. The less competition you have, the easier it is for the domestic players to pass through price increases when you have a depreciation of the currency.
Did you want to say something, Ben? No? Frans?
Thanks, Governor. Just the usual again.
Yes, it was unanimous.
Okay, and was a hike discussed at all?
Not in the sense of saying, should we raise rates? But the questions that we've raised here about our concerns of where inflation expectations are, and that the concerns that inflation has breached the target means that we certainly discuss the issue of, the kind of expectation we would have is that should the conditions deteriorate, this is certainly something on the table. But we didn't discuss whether at this point in time we needed to hike rates. That was not on the table. But the principle of saying our concerns reflect an increased, and we've said clearly in the statement, there's certainly an upward bias in terms of the risks to inflation. So it wasn't about discussing a rate hike for now, but our concern as to what we're seeing coming down the track.
And nobody was leaning towards a rate hike?
No. Not left or right leaning. You have a question?
Governor, a question from Peter Montalto.
How are you, Peter?
There's a lot of skepticism amongst SA locals, more than foreigners, that you are ready to hike to defend the inflation targeting framework. Given you would negatively impact growth through a variety of channels, especially given the indebtedness of households, how would you answer that charge? Thank you.
Well, I think we have answered it, Peter, that we have a policy dilemma in that you've got issues around inflation that militate towards a particular policy, and at the same time, because you have rising inflation and slower growth, a slower growth requires a different policy. And that's why we're looking at it and saying, as far as we're concerned, we're holding the rate steady at this point in time. It is as much a decision as raising and lowering. Holding is also a decision. That takes a lot of discussion and thought as to whether that's the appropriate stance to take. But precisely because these things interact with each other in the manner that they do, and part of the challenge for South Africa is to use the opportunities that have arisen. We're in a region that is a growing region. Take advantage of the interaction with the sub-Saharan Africa and the growth story that is there. The question of increasing our exports, deal with the current account deficit, make sure that we look at ways in which we can stimulate growth that is not interest rate dependent. There's a whole lot of other areas that need to be dealt with in the economy to ensure that that growth takes place. That in itself will help create room and deal with many of the challenges that we face. So the answer is that we have to deal with both issues at this point in time, bearing in mind that price stability is our primary mandate, and that is what in the end will prevail. But at this point in time, we didn't think it was appropriate to deal with now. You want to add?
I hope Peter was correctly quoted. I hope he meant to say the SAP defends the inflation target, not defend the inflation targeting framework.
Yeah.
We don't have to defend the inflation targeting framework. It is an accepted policy framework in the country, and our task as the Reserve Bank is to pursue our mandate within that inflation targeting framework.
Yeah, I assumed it was the former, which is what I answered, not the question of defending the framework. But thank you. Yes, Tshepo.
My next question is slightly different but relevant. Parliament is currently looking at the credit amnesty legislation, and banks have indicated that this is not the right way to do things. And in the light of one of your role being banking and financial stability, what is your take on that? Is there any risk from that particular legislation should it go through?
Mr. Ansipo-Lele?
Look, we have not seen the details. Firstly, the concept of the amnesty itself. I think that from where we are sitting, we would be concerned about two things. Firstly is, what would the economic implications of a credit amnesty be? The ideas might sound very noble, but then what do the economics tell us, and what would the implications be for the flow of credit? And at the moment, it is not clear that that work has been done. And a priori, one would say that when you declare an amnesty and you clear records, you could end up with a situation where lenders say, well, we do not have any history of this particular borrower, and hence we might not be able to lend. So it might have implications to the flow of credit, and we hopefully, in considering the amnesty, Parliament would be alive to those aspects. In as far as financial stability aspects of the amnesty is concerned, I think that there is a cut-off that is proposed. I think it's for loans below 10,000 or so. And one would have to quantify and say how many or how much of these loans and what do they mean. Bear in mind, it doesn't say that the credit is written off. It just says that your bad credit record would be expunged. There's been a history. Remember that when the National Credit Act was introduced, there was a similar amnesty. I think that we should just be aware that we do not get addicted to having amnesties now and then.
Yes, sir.
Hi, Governor. It's TJ Stedham from the Times. Is now a good time to take a home loan?
It depends on your affordability.
Thank you, Governor.
Another question?
Governor, a question from Razia Khan. Please, could you shed more light on your assessment that South Africa's negative output gap is widening? Thank you.
Output gap. Brian?
Currently, our estimate of potential output is around about 3.5%, with growth going at an annual rate of about 2%. It does mean that the actual output gap is widening. So at this point in time, and for some time now, we have been, our growth rate has been below potential, and we see it remaining so for the foreseeable future. I think our forecast for this year, as we said, is around 2%, about 3.3% next year. If we do achieve the 3.6% that we anticipate for 2015, then we should start to see the output gap closing.
Anyone else? Wait, let's just see if there's anyone who hasn't asked a question, would like to.
I'd like to ask, how does the MPC decide by how many basis points to increase or reduce the repo rate? What do you take into consideration?
Kuben, do you want to try that one?
When interest rates were quite high in South Africa in the sort of 80s and 90s, there were certainly interest rate changes of 1 percentage point at a time. As interest rates have gone lower, we've reduced that margin to sort of half a percentage point, and sometimes even a quarter percentage point. I guess it depends on how much an impact we think it would have on the economy. So, for example, if interest rates are 25%, and we think that we should reduce interest rates, if we reduce it by half a percentage point, it won't have any impact. But if interest rates are at 5%, and we'd like to reduce interest rates, then at 5%, reducing it by half a percentage point might have an impact. So in some ways, it depends on the overall level of interest rates, but also how much inflation has risen by, and how fast we want to bring it back to.
Okay. Anyone else? No? If not, thank you all very much. Thanks, colleagues. And thank you all for being here and for enabling us to answer your questions and coming through to Pretoria. And we look forward to seeing you at our next MPC meeting in November. Thank you all.